Good afternoon and welcome to the Post-Monetary Policy Committee press briefing. The Monetary Policy Committee held its December meeting yesterday, the 9th of December 2025. And today, as usual, the chairman of the MPC, who's also the governor of the Central Bank of Kenya, will take you through the deliberations, or at least the thinking behind the MPC and its decision. And thereafter, please feel free to ask your questions. If you want to ask your questions, please do so through Slido. That's slido.com, slido.com. Please make sure that you include your name and your media house as you ask the questions. But for now, we'll have the governor run us through that presentation, and after that, we will come to the question and answer session. So, Governor, over to you.
Good afternoon, everyone. During its meeting on December 9th, 2025, the Monetary Policy Committee decided to lower the central bank rate, the CBR, by 25 basis points to 9% from 9.25%. The MPC observed that overall inflation is expected to remain below the midpoint of the target range in the near term, and that this will be supported by lower prices of processed food items, stable energy prices, and continued exchange rate stability. The MPC also noted that central banks in the major economies have continued to ease monetary policy, but at a cautious and uneven pace depending on their inflation and growth outlooks. The committee also noted that average lending rates in the domestic market have continued to decline, while private sector credit growth has continued to improve, though at a slower pace than is desirable. The committee therefore concluded that there was scope for a further easing of monetary policy stance by reducing the CBR by 25 basis points. This will augment the previous policy actions, which were aimed at stimulating lending by banks to the private sector and supporting economic activity, while at the same time ensuring inflationary expectations remain firmly anchored and that the exchange rate also remains stable. The MPC will closely monitor the impact of this policy decision, as well as developments in the global and domestic economies, and stands ready to take further action as necessary in line with its mandate. The committee will meet again in February of 2026. The committee began its deliberations by looking at the global economic developments and outlook. They noted that despite higher tariffs on trade, global inflation is projected to decline in 2025 and also in 2026, and this will be driven by lower energy prices and reduced global demand. The headline inflation, global headline inflation, is projected to decline from 5.8% in 2024 to 4.2% this year, and a further drop to 3.7% in 2026. In regard to the international oil prices, these have moderated owing to increased production and subdued global demand, but have been volatile due to elevated global uncertainties. The OPEC Plus producers raised oil output by 137,000 barrels per day, both in November and December of 2025. It is also expected that non-OPEC oil producers will increase their production, and the main risk to oil prices relate to any supply disruptions from escalation in geopolitical tensions, particularly in the Middle East, and also in regards to the conflict between Russia and Ukraine. With regard to food inflation, this declined in November 2025 from -0.2 to -2.1%. And the main reason for this reduction was lower cereals, sugar, and edible oil prices, all of which was expected to for an increase in supply of sugar from from Brazil and India, as well as Thailand, and an increase in supply of edible oils, also from Malaysia. And the result would be that global food inflation index, as I said, would decline or did decline in November by minus 2.1. Looking at inflation of some of our major development partners, and in particular the US, UK, and the Eurozone, we see that inflation in those countries has eased modestly in recent months, but is still above the target, mainly on account of stickiness in the core inflation. On the left-hand side, you can see that that's the headline inflation for those four areas, including China. And really, as you can see, perhaps from the beginning of 2024, there really hasn't been very much movement downward of headline inflation. And again, the reason for this is, again, moving to the right side of the panel with core inflation, and core inflation has really remained well above the target of 2%. And this has kept up the headline inflation to where it is. Turning to global economic growth outlook, the global growth has remained resilient and is projected to grow by 3.2% this year. And this is supported by improved financial conditions, as well as strong consumer and business spending, particularly in the United States. It is, however, projected to slow down to 3.1% in 2026, owing to higher tariffs. Just focusing on the US, you can see the growth is expected to decelerate from 2.8 to 2%, and then to increase slightly to 2.1%. These are revisions upward from the July 2025 projections. Similarly, for the United Kingdom, these estimates were also revised upward, certainly for the 2025. And so we expect growth in the UK to increase from 1.1% in 2024 to 1.3% in 2025, and to remain at that growth rate of 1.3 in 2026. In regard to the euro area is expected to growth is expected to accelerate from 0.9% in 2024 to 1.2%, and to slow down slightly to 1.1. Again, moving further down, you can see China also is expected to slow down. India remains relatively resilient, and as well as Saudi Arabia, where we do get quite a significant amount of remittances. We do see that the growth is expected to recover quite significantly from 2% in 2024 to 4% in both 2025 and 2026. The main risk to this growth projections is the weak global demand, the elevated trade policy uncertainty, and the heightened geopolitical tensions in the Middle East and the Russia-Ukraine conflict. These are the main risks to this growth outlook. In the case of Kenya's growth is expected to remain above the global emerging market and developing economies, as well as the sub-Saharan Africa averages, mainly reflecting the resilience and diversified nature of the Kenyan economy. With regard to the global financial conditions, these have improved, as reflected in the recovery of major equity markets and the decline in Eurobond yields in most emerging and developing market economies. On the very left-hand side, you can see the performance of selected stock indices, and all of them have been going upward, reaching historical highs. In the middle panel is select African countries' Eurobond yields. Most of them trending downward, with the exception of Senegal. And then on the right-hand panel is Kenya's Eurobond yields, which also have been trending downward. And indeed, as of last week, we did see that all the yields had actually declined to below 9%. So to summarize on the global developments and outlook, the global inflation is projected to decline both in 2025 and in 2026. And this is largely because of lower energy prices and reduced global demand. The central banks in the major economies have continued to ease monetary policy, but at a cautious and uneven pace, depending on their inflation and growth prospects. Global growth has remained resilient in 2025, but is projected to slow down slightly in 2026 due to higher tariffs on trade. The global financial conditions have improved, as reflected in the recovery of major equity markets and the decline in Eurobond yields for emerging markets and developing economies. Risks to the global growth outlook remain elevated due to the elevated trade policy uncertainty, weak global demand, heightened geopolitical tensions in the Middle East, and the Russia-Ukraine conflict. And finally, Kenya's growth is expected to remain above the global emerging market and developing economies, as well as the sub-Saharan Africa averages, and this reflects the resilience and the diversified nature of the Kenyan economy. Turning to domestic macroeconomic developments and outlook, the overall inflation declined in November 2025, driven by lower core inflation, but remained below the midpoint of the target range of 5 plus or minus 2.5 percentage points. The core inflation declined from 2.7 to 2.3, and this more than offset the increase in core inflation, which rose from 9.9% to 10.1%. And the result was that overall inflation declined from 4.6% in October. It was also 4.6% in September. And so for November, the decline in core inflation resulted in the headline inflation declining from 4.6 to 4.5. As I just indicated, core inflation declined in November of 2025, and this was on account of lower prices of processed food items, particularly maize flour and sugar. And you can see the main contributor to the decline in core inflation from 2.7 to 2.3 is the processed food items in blue, where the contribution to the core inflation declined from 1.27 to only 0.98. Non-core inflation increased in November, and this was mainly driven by prices of vegetables, and in particular tomatoes, onions, and cabbages. And again, looking at the movement of non-core inflation from 9.9 to 10.1%, The contribution by energy remained unchanged at 1 percentage point. The same for transport remained unchanged at 1.1. So what really drove the increase in non-core inflation was food, and again, because of tomatoes, onions, cabbages, as well as carrots. So our forecast for inflation going forward for the 12 months up to November 2026 show that inflation will remain below the midpoint of our target range and will not exceed the 5% midpoint all the way from now on to November of 2026. Turning to inflationary expectations sensed by the private sector, the November 2025 MPC Market Perceptions Survey, as well as the Agricultural Sector Survey, show that inflation expectations remain well anchored within the 5 plus or minus 2.5% target range in the near term. Specifically, for the agricultural sector, inflation expectations in the next 3 months of those who responded, 55% expect an increase in inflation within the next 3 months, and 45% expect a decline or inflation to remain unchanged. The respondents to this survey, to the agricultural sector survey, expect improved food supply following recent harvests, particularly of maize. They also expect stable pump prices and a stable exchange rate to support a stable inflation rate in the near term. Nevertheless, as I indicated, the majority, 55% of the respondents, expect seasonal factors associated with the festivities in December and higher prices of some food items, and in particular vegetables, to exert moderate upward pressure on the overall rate of inflation. In looking at the market perception survey, we do see that the inflation expectations in the near term also remain anchored within the target range. And again, this is due to exchange rate stability, improved food supply, stable global oil prices, which are expected to keep local pump prices and transport inflation stable. For the banks, the inflation expectation is around 4.5% in the next 2 months or so, whereas for the non-banks, they expect an inflation rate of about 4.59. So to summarize on developments and outlook for inflation, the overall inflation stood at 4.5% in November 2025 and remained below the midpoint of 5%. The overall inflation is expected to remain below that 5% midpoint of the target range in the near term, and this would be supported by lower prices of processed food items. It will also be supported by stable energy prices on account of lower international oil prices, and the exchange rate stability is also expected to continue to moderate prices. The November 2025 MPC Market Perceptions Survey and the Agricultural Sector Survey shows that inflation expectations remain anchored within the target range in the near term. And the main risk to the inflation outlook relate to an uncertainty regarding weather conditions, higher tariffs on trade, and geopolitical tensions, particularly the war in Ukraine, the Middle East conflict, with implications on volatility in oil prices. Turning to the domestic economic growth, the growth is expected to pick up in 2025 and also in 2026, supported by continued resilience of key service sectors and the agricultural sector, and also the continued recovery of the industry sector. The overall growth for 2025, we expect the GDP to grow by 5.2%. This is an increase from the 4.7% that was recorded in 2024, and we expect a further acceleration of real GDP growth in 2026 to 5.5%. These projections have remained unchanged. We have not revised these projections. They remain as they were the last time we had the MPC. And the agriculture sector growth is expected to remain robust, supported by favorable weather conditions, subsidized fertilizer, and irrigation expansion. The industrial sector continues to recover, driven by construction and affordable housing program, and also reflecting the settlement of pending bills. The key service sectors are expected to remain resilient, supported by continued digitization of the economy, expansion of e-commerce, as well as the easing cost of credit. The improved uptake of credit across key sectors is expected to support growth. And we do see, when you look at sectoral growth in credit to the private sector, we do see a significant improvement from last year in manufacturing, at least since May or so. We've seen positive growth in credit to the manufacturing sector, which has been increasing and reached 11% in September, although it has decelerated slightly to 7.9% in November. But similarly, trade credit expansion to the trade sector, building and construction, I already referred to that. You can see a very significant increase in credit to the building and construction sector. And similarly, credit for consumer durables remains quite robust. So in regards to the CEOs and again the market perceptions survey, these surveys revealed sustained optimism about domestic business activity and economic growth prospects for the next 12 months relative to the projected growth in 2025. Specifically for the banks, only about 13% of those interviewed were pessimistic about growth prospects for the next 12 months. On the other hand, 87% of those who participated, which was all banks, by the way, the 87% were either very optimistic about growth or optimistic about growth. In regard to the non-bank private firms, only 20% of those interviewed were pessimistic compared to 80% who were either very optimistic or optimistic. For the CEO survey, 43% felt that growth would be higher than 2025. 40% felt it will be about the same level, and only 16.7% felt that growth would be lower in the next 12 months in 2026 compared to 2025. And this optimism was attributed to resilient agricultural production supported by favorable weather conditions, the stable macroeconomic environment with lower inflation and stable exchange rate, and declining interest rates and improved private sector credit growth. Some respondents did express concerns about subdued consumer demand, the high cost of doing business, and increased global uncertainties attributed to higher tariffs and to geopolitical tensions. So to summarize on domestic economic growth and prospects, the economy remained resilient in the first half of 2025, and this was on account of a rebound in activity in the industrial sector, stable growth of the agricultural sector, and resilience of the service sectors. Leading indicators of economic activity also point to improved performance in the third quarter of 2025. So real GDP growth is projected at 5.2% in 2025 and 5.5% in 2026. And of course, this is an acceleration from the 4.7% that was recorded in 2024. The MPC surveys conducted in November of 2025 revealed sustained optimism about business activity and economic growth prospects for the next 12 months. And this outlook is subject to risks, including adverse weather conditions, elevated trade policy uncertainties, and geopolitical tensions. Turning to monetary policy, the implementation framework, this is a framework that we introduced in August of 2023. We have continued to refine this framework, and you can see the difference between the beginning part and the part towards the end. But more importantly is the convergence of the Kesonia, which is the Kenya shilling overnight interbank average, which is the pink line. And you can compare that with the blue line, which is the CBR. And you can see the divergence at the beginning of the implementation of this framework. And you can see the convergence towards the end where even from October to November, you can see that there's virtually no difference between the Kesonia and the policy rate, the CBR rate. Now, following the easing of monetary policy by reducing the CBR, and also earlier on in the year, we did lower the cash reserve ratio from 4.25 to 3.25. And of course, also in some of the interventions that we've had in the foreign exchange market in terms of purchases of Forex. This has increased liquidity in the system and has contributed to reducing the treasury bill rates, the 91-day, the 182, as well as the 364-day T-bills, all have reduced by almost, some by more than 50% in the case of the 91 and 182 days. And for the 364, that has reduced from almost 17% to the current level of 9.4%. On the right-hand side is the developments in the average commercial bank interest rates, both the lending rates as well as deposit rates. And there you can see that the lending rates, which is the top line, have have declined from 17.2 to 14.9, and at the same time, the average deposit rate has declined from a high of 11.5% to the current level of 7.3. Now, of course, we do recognize that the spread between the lending rate and the deposit rate has widened, and we do expect that the banks will continue to lower the lending rate so that this gap, the spread between the two rates, goes back to the more historical levels and not the current high levels. Reflecting that reduction in interest rates charged by the commercial banks, we've seen a recovery in credit expansion to the private sector, and we've seen from a contraction or a reduction of 2.9% that was recorded in January of 2025. We've seen a continuous improvement in credit that is going to the private sector, and as of November 2025, we saw the expansion of the growth in credit reached 6.3%. So on monetary developments and the summary, Kesonia, this is our operational target for monetary policy. This has continued to closely track the central bank rate. The short-term interest rates have declined further in line with the recent reductions in the CBR, and reflecting the lower lending rates, growth in credit to the private sector has increased from minus 2.9% in January of 2025 to 6.3% in November of 2025. Commercial banks' average lending interest rates declined in November 2025, with a decline in short-term rates expected to transmit further into lower lending rates and improved lending to the private sector. Turning to the balance of payments, the overall balance of payments is projected to be in surplus both in 2025 and in 2026, mainly reflecting surpluses in the financial account. Specifically, looking at the current account deficit, the first row labeled A, we see the current account widening from about $1.55 billion in 2024. For this year, 2025, we expect that current account to widen to 3.23, and then to widen further slightly in 2026 to $3.3 billion. On the other hand, under item B, financial and capital account, we do expect enough capital inflows. These are foreign direct investments, these are portfolio inflows, as well as the investors, foreign investors investing in the government securities. We expect the combination of all that to more than offset the deficit in the current account. In other words, for 2024, the financial and capital account, we had 3 billion of inflows compared to current account outflows of 1.5, and therefore we had an overall balance of payments surplus. In 2025 and 2026, we expect inflows in the financial and capital account of $5.17 billion and $4 billion respectively, and to have overall balance of payment surpluses in 2025 and 2026 of $1.9 billion surplus and $681 million. both of which will support our continued build-up of international reserves. So the current account deficit in terms of GDP was 2.1% in the 12 months to October of 2025, and compared to minus 1.5% in the same period in 2024. And as I indicated, we expect a further slight small widening to 2.3% of GDP for 2025, and to continue at the same level of 2.3% into 2026. The goods export increased by 6.7%. Again, in the 12 months to October of 2025, they reached $13.17 billion. And this was the 6.7% growth was compared to the similar period in 2024. And this growth was driven by horticulture, and here we are talking about fruits, flowers, and also vegetables. And coffee also, we've seen very strong growth in earnings of coffee, manufactured goods also, and apparel exports. For the year as a whole, this year we expect an increase in total exports of 6.4%, which will be followed by an increase of 10% in 2026. So if we disaggregate the exports of goods into re-exports and domestic exports, we do see that domestic exports are indeed increasing at a significant pace of 7.6%. However, re-exports declined by 10.1% due to lower imports of jet fuel, partly attributed to lower international oil prices. Turning to goods imports, for the 12 months to October, we saw an increase in imports by 9.6%. And for the year as a whole, we are expecting imports to increase by 10% this year and to increase by 8% in 2026. And these increases largely reflect importation of intermediate as well as capital goods. For the 10 months, here you can see that compared to last year, we had an increase of 8.2% between 24 and 23. And then we've seen an acceleration of imports, again, intermediate as well as capital goods. And therefore, for the 10 months from January to October this year, we've seen imports grow by 10.1%. In regard to services receipts, these increased by 4.8% for the 12 months to October of this year compared to the same period last year. But we do expect a slowdown, particularly in transport services, and therefore we see a marginal increase in services exports for 2025 of 1.4%, but then for 2026 we do expect some recovery. Tourist arrivals remained resilient in the 12 months to October of 2025, growing by 6.3%, mainly on account of recovery of international travel and also government measures to identify new source markets. In regard to remittances, these have remained resilient, despite increased global uncertainties supported by diversified source countries and the impact of government policies to export skilled labor. For the 10 months of 2025 compared to 2024, we saw remittances increase by 3.3%, and that's why we have projected an increase of 3.4% for the year as a whole. And this is obviously significantly lower than the growth of 18% that was recorded in 2024. I think one of the challenges we are having is that one of the fastest growing source of remittances, which was Saudi Arabia, we have experienced quite a significant slowdown in remittances from Saudi Arabia. We expect that this will be temporary as they sort out this issue of skill-based work permits, and that by 2026, the robust growth in remittances, in particular from Saudi Arabia, will recover, and therefore expect remittances in 2026 to increase by 6%. The foreign exchange reserves of the CBK have increased quite significantly, as you can see from there. And now, as of December 8th, recorded $12 billion, which was equivalent to 5.3 months of import cover. And we believe that this level of reserves does provide adequate cover and a buffer against any short-term shocks. The Kenya shilling dollar exchange rate continues to be stable, and this is supported by diversified foreign exchange inflows, which I just described, the confidence in the economy, and of course the build-up of reserves itself offers some comfort and confidence that the exchange rate will remain stable. In terms of market sentiment vis-a-vis the exchange rate developments, with banks, we expect, or at least from the survey, about 3/4, about 76% of both banks and non-bank respondents actually expect either the exchange rate to remain where it is or to strengthen slightly. And again, these expectations of a stable exchange rate reflects the expectation of increased tourism activity, especially during this festive season, the strong diaspora remittances, portfolio inflows, and improved inflows from tea, coffee, and the horticultural exports. Some respondents did expect some moderate pressure arising from the increased import demand and seasonal factors associated with increased demand for consumer durables during the festive season. So to summarize on the balance of payments, developments, and outlook, the current account deficit stood at 2.2% of GDP in the 12 months to October of 2025. And this was compared to 1.5% in a similar period in 2024. We expect the current account deficit to stabilize at 2.3% in both 2025 and also in 2026, mainly reflecting continued growth in goods imports, but also resilient exports growth and diaspora remittances inflows. The current account deficit will be more than financed by financial account inflows in both 25 and 26. And therefore, we expect overall balance of payment surpluses, which will go towards building our international reserve position. And it is our projection that by the end of 2025, our reserve position will be at 12 billion. And then by the end of 2026, this will increase to roughly $12.5 billion. The downside risk to this balance of payments outlook would be, again, the deterioration of geopolitical conflicts, the persistent and elevated trade policy uncertainty, and this could impact the export-intensive industries, and finally, volatility in the international oil markets. Turning to banking sector developments, the banking sector remains stable and resilient. The capital adequacy and liquidity ratios for the banking sector have remained above the minimum statutory limits of 14.5% and 20% respectively. The total capital adequacy ratio stood at 19.9% in October of 2025. This is slightly lower than the 20.1% in August, but clearly much higher than the minimum statutory limit of 14.5. And similarly, the banking sector liquidity ratio was 59% in October 2025. Again, this is compared to the 20% minimum statutory limit, and the 59 was a slight decline from the 59.8% in August of 2025. The ratio of gross non-performing loans to gross loans stood at 16.5% in November of 2025. This is compared to 16.7% in October and a high of 17.6% in August. Banks have continued to make adequate provisions for the NPLs, and the sector remains profitable and provides sufficient buffers. The revised banking sector risk-based credit pricing model, which will be fully operational by March of 2026, should improve the transmission of monetary policy decisions to commercial banks lending interest rates, and also enhance transparency in the pricing of loans provided by banks. On fiscal performance, its government continues to plan for fiscal consolidation over the medium term and to reach a deficit of roughly 3% by 2029-2030. Finally, to a summary and the key takeaways. On the global front, inflation is projected to decline in both years of 2025 and 2026, reflecting lower energy prices and also reduced aggregate demand. The global growth has remained resilient in 2025, but is projected to slow down slightly to 3.1% in 2026, and this is due to higher effective tariffs on trade. On the domestic front, the overall inflation remains firmly anchored within and below the target range of 5%. The Kenyan shilling against the US dollar has remained stable, and interest rates have continued to decline, which should continue to support growth in credit to the private sector and improved economic growth prospects. And therefore, with the stability in prices and the exchange rate, the CBK has continued to support the government's economic growth objectives as reflected in the further reduction of the central bank rate. Thank you very much.
Thank you. That was the Governor of the Central Bank, who's also the Chair of the Monetary Policy Committee, Dr. Kamau Thugge. We now go into the questions which you have been sending in. We'll begin with George Obulutsa from Reuters, who asks, what's the latest on Kenya getting a new IMF program? And additionally, what concerns does the bank have about drought affecting the 2025 and 2026 GDP growth and inflation forecasts? A related question from Fortune Ochako, who is at Money Academy, and who asks for progress on why Kenya hasn't secured a new IMF deal. Jimmy Mbogo, I notice you have a similar question about the outcome of the negotiations with the IMF. So all those three questions are related. And additional to that, like we said, from George, is about forecasts, especially with the drought. And finally, in this batch, Kefa Moirore from the Nation Media Group, who was asking, have all 37 commercial banks submitted their revised risk-based pricing formulas, and will the central bank make these computations public?
Yeah, let me start with the IMF program. We continue to have discussions with the IMF on getting a new program, a new funded program. The president did meet with the managing director of the IMF, I believe last week, and we do expect a staff visit from the IMF sometime in January to continue the discussions on the IMF program. We have taken into account the impact of the drought on the GDP growth and the inflation forecast. And indeed, if you do look at the path for especially the non-core inflation, you will see that inflation, certainly for vegetables, remains elevated for the next 2 or 3 months, and then it does come down, starting with the long rains around April to going forward. But the bottom line is that notwithstanding that, we don't see the overall inflation going beyond the 5%. We do think that the core inflation, which is at 2.3%, will continue to anchor the overall rate of inflation. As you are aware, the contribution of core inflation to the overall inflation is 81%, and so it tends to dominate and pull the overall inflation towards where the core inflation is. So we continue to project and see that the overall inflation, the headline inflation, will still be below the midpoint, be below the 5%, certainly up to November, where we stopped the projections.
Thank you. In the second batch of questions, is there something I've left out?
Sorry, sorry. There was also I missed this question. The question was from Kefa Moirore, and have all 37 commercial banks submitted their revised risk-based pricing formula. And we'll see CBK make this computation public. Yes, the commercial banks, they have, all of them have submitted their risk-based pricing formula that they will be implementing. As we've said in the past, we expect this to be a very transparent process. Some of the banks have chosen to use the CBR as a reference rate. Others have chosen to use the Kesonia as the reference rate. And yet others have chosen to use both the Kesonia as well as the CBR. But as I indicated earlier, when we were looking at the monetary policy implementation framework, and I did emphasize the fact that there was convergence between Kesonia and the CBR. So in that sense, it makes it easier for the banks either to use the CBR or to use Kesonia, because essentially the two are roughly the same.
Thank you, Governor. The second batch of questions are actually related to some of the ones you've answered, but let's look at them. Stephanie Kimani from I&M Bank says non-core inflation remains elevated. So is the central bank concerned about a potential mismatch between improving credit growth and still stressed household balance sheets? For Jimmy Mbogo is just what you've spoken about, but he asks, could you share the number of banks that have opted to retain the CBR as the base lending rate and why? Back to Kefa Muirore. Kefa is asking, what is the central bank's view on emerging concerns that the exchange rate has affected the US dollar, and do you stick by your long-held stance on non-interference?
Yeah, I think Stephanie Kimani, as I just indicated, yes, we expect non-core inflation to remain elevated for the next few months, but we also expect core inflation to remain relatively low, and that we also expect the overall inflation to remain below the 5%. So I think going forward, of course, as we indicated, our next Monetary Policy Committee will be in February. At that point, we will look at what will be happening to the inflation rate. We will look at what is happening to the growth as well. We will look at what is happening to credit to the private sector. And then at that point, we'll make a decision on what to do about the policy rate. Of course, our intention is to ensure that credit expansion to the private sector continues to grow beyond the 6.3% that was recorded in November. And I think that way it will be that scenario with lower interest rates, higher credit to the private sector will be supportive of the overall GDP growth. I'll have to get back to Jimmy Mbogo on the number of banks that have opted to retain the CBR. I don't know whether Mbogo is here. But if I can remember off the top of my head, I think maybe about 48% used the CBR, and about another 34% has used the combination of both the CBR and Kesonia, and then the remainder is those who have chosen to use Kesonia only.
Thank you. Yep, sorry. Go ahead.
There's this issue of, I think, Kefa, we stick to our long-held stance on non-interference. And again, we don't, we have not told banks not to hold their, to stick to a particular exchange rate level. And I think as a way of, it's just, testing the market, to go and see if you have some dollars with you, see whether you can go and sell those dollars at even 131 or 132 shillings to the dollar. Yeah, that's the market, and that's what I say. This exchange rate is market driven, and if you don't believe it, try and sell your dollars at a higher rate, or go to a place and try and buy dollars at below the current rate of about 120, ranging between 129 and 130. So yeah, so we this is our stance, that it is market driven, and if you want to experiment, go to the banks or go to the foreign exchange places where they sell the foreign exchange, and see whether you'll be able to sell or buy outside the rate that is published by the central bank.
Thank you. So the last one, interesting, is just a single question. This is from Churchill Ogutu. Churchill is from IC Asset Managers. So here's a bit of detail. So he's asking about the balance of payment projection. So he says the 2025 balance of payment projection is now at $1.9 billion, up from $670 million in the October Monetary Policy Committee. Could you unpack the higher financing flows that have been penciled in this time round between October and December?
I think, Churchill, the overall balance of payments for 2025 really has not changed that much from the previous MPC. And the reason for that is, you see, even at the last time of the MPC, our reserve position was quite significant. Yeah, and you may recall that at the end of 2024, the reserves that we had were about 10-point-something billion. And we are now hovering just about 12 billion. And as of October, our level of international reserves must have been at least 11, maybe 11.5 or something like that. So if you take the difference between 11.5 and the beginning period, you see that the change in reserves, which is also the balance of payments, was something to that, the 1.9. I will check again, but I know how we do the calculations. In fact, for 2025, we did have the balance of payments of 1.9 surplus, but we also had expected some disbursements from the IMF earlier in the year. And the combination of both the overall balance of payment surplus and the disbursements from the IMF, we were therefore able to build reserves by something like $2.5 billion.
So thank you. That brings us to the end of this session. And this is the last on schedule for the year as we're in December. And so, as we usually say, the MPC meets every 2 months. So the next expected meeting is in February of 2026. So if we do not see each other before then, do have yourselves a very Merry Christmas, Happy Holidays, and have a Happy New Year. Thank you very much, and do have a good afternoon.